So Rocco is with SAS, and he works there as, I believe, in the risk management earlier department, and now general research or something like that.
Yes.
Research and development, which is a huge corporation, and to be that high a position is a tremendous accomplishment on its own. But not only that, but he is an options educator, and he's published a lot, quite a bit, I believe. So I'll hand it, and later in the meeting we'll also have Mike Rulison talk on another topic, which he will get into. But for now, I'll hand it over to Rocco.
Right. Thank you, Don, and thank you, everyone. Apologies again for the delay. I'll try to speed up a little bit to catch up. So just a quick introduction on the content of today's agenda. So this is meant to be kind of a basic introduction, so it's not going to be an advanced topic. So we'll cover some advanced topics a bit later towards the end of the presentation, but the idea was to try to cover all the basics. So I'll try to provide all of the building blocks necessary to explain what the zebra trade is about and how to get from there. So obviously, if you have any questions at any point in time, please feel free to ask. I'm not going to spend a lot of time by myself because I've already. Go ahead, please. I can't because it's only showing one or the other. So, and I'm not sure if anyone is seeing my screen. Actually, let me share my screen. I can only share one screen at a time, and this connector is not working well with the laptop. I know, but I cannot switch. I know, but I cannot switch the screens. I'm sorry about that. So hopefully everyone can see my screen now. So let me check if anyone. Okay. So just about me very quickly. As Don said, I work at SAS, but I also work in a company called Option Traders. We do financial education and research. The only reason I'm putting this slide is so that everyone has my email address in case you want to contact me for questions forward. So I'm not going to talk about myself. Before we get into the trade, obviously I have to do a disclaimer. So obviously options trading involves risks. So please trade at your own risk. All of what you see today is for education purpose. Okay, so let's start with the first basic, which is owning stocks. So why do people buy stocks? Is because companies release shares, and when you own a share, you're basically owning a portion of the company, right? What happens is obviously the better the company does, the better the share price typically, and so the return on the investment as an investor is based on two components. One is the fact that the company grows, which means the share value is going to increase, as well as the dividends. I will get some dividends back from owning the shares in the stock. Not all companies give dividends, but most of them usually do. So the whole point of this slide is to say, well, the combination of a growth plus the innovation that the company basically creates over time makes the price increase over time. And that's what we see usually with companies. Of course, some companies fail, but the majority usually, like, as the time goes by and they become bigger and bigger, so they grow. So that means that longer term investment typically has a positive return. Obviously, these are the payoffs for a long stock or a short stock. So on the long side, obviously, if I buy, I want the stock to go up. If I'm selling shares of a stock, this is short selling. Obviously, I want the stock to go down. So these are the only two things that I can do when I buy or sell a stock. With options is a little bit more complicated. We essentially have two types of options. We have puts and calls, and we can buy them. So we do long calls, long puts, or we can short them. And one thing that I noticed that people at the beginning struggle with is how do I remember, is it a long stock I want to go up or want to go down, or how to relate between all of these combinations. So I kind of came up with a mnemonic way, at least for beginners, to remember how, where do you want the stock to go based on what you're buying or selling. And so the idea is use your hands. Your right hand is your call, and your left hand is the put. And you put your palms up, and you look at your finger. The finger points to the right, which means if it's a long call. So your right hand's on the points on the right side, so you want the stock to grow. If it's on the left side for the put, you want the stock to grow, to decrease in value. When you are looking at shorting, so selling a put or selling a call, it's a similar concept, but in this case, we're just going to flip the hands. So palms down, and you follow the finger, and that's going to give you an idea of where do you want the stock to go. I'm not going to spend too much time on this one, but it's just to give an idea for, who is at the beginning. This was at the beginning, it was very difficult to always remember what do I want to do and what is it about. Obviously, as you trade more and more, this becomes second nature, but at the beginning, it's a little bit confusing. So hopefully this one helps. All right, so here's what I'm going to do is we really want to compare buying a stock versus buying a call first, because that's going to be the basis to get to the next stage. And the idea is we're looking today at the long-term investment type of trading. So it's not necessarily for short-term, although this type of trading, this strategy can be used for short-term. But the idea is, what if I want to have a permanent portfolio for the long-term? Is it better to own stock, or maybe are there alternatives? And so we'll look at these alternatives. So if you look on the left side, we basically have, let's say I'm going to buy 100 shares of SPY, the S&P 500, and the share price is $420. This was taken in the month of August. So right now we're about 450, but give or take. And so let's look at what's the maximum risk. Well, obviously, if the stock price goes to zero, which is, well, maybe low probability in case of SPY, but let's say it goes to zero, my maximum risk is $42,000 because I'm buying 100 shares at $420 per share. So $42,000 is my maximum risk. What's the margin that is going to be required by my brokerage account? Well, it depends on what type of margin do you have. If you have portfolio margin, if you have regulatory margin, there's different types of margins. But typically, your broker is going to require on a standard account 50% of the mortgage, which means you only have to post half of the money as a collateral in case the stock goes down. So that brings down your actual cost to enter the trade, in this case, to $21,000. Okay. Now, what happens is, if the stock goes up, I have maximum profit to be infinity, because basically, as long as the stock goes up, I can make as much money as possible. And the leverage here is measured as basically what is the value of the notional, so $42,000, compared to what is the amount of capital of margin that I need to hold, right? And so in this case, you have a leverage of 2 to 1, because I can basically control $42,000 worth of nominal price for just $21,000 of capital upfront. Okay. Now let's take a look at the same case with a call. Well, with a call, again, taken at 30th of August, I think this was. So I looked at the price of a long call at the money, so at the strike of 450, I think back then was the price. And so looking at that price, that call cost basically $4.1, which multiplied by 100 shares, because a call controls on the shares, that means that the maximum risk is $4,100. This is the maximum amount of money that I can lose if basically, if the call expires at the end of the expiration, worthless. This is a call that I've selected at 387 days into the future. So this basically, I took like a year of expiration, more or less, to give us an idea, because we're looking at longer term type of investments here, right? So now we can see right away that the maximum risk in case of a stock is $42,000. The maximum risk in case of a call is $4,100. Now the next thing is, what is the margin? Well, the margin is going to be exactly the cost of the call, so it's still for 4,100. The maximum profit is again the same as the stock. Basically, as long as it goes up, I can make more money. So there is no limit to the upside. And the leverage in this case is 10, because basically I can control $42,000 worth of stock for the price of 4,100. So basically 10 to 1 ratio. Okay. So if you just look at this one, you may say, well, the call is the obvious winner, but that's not the case. And we'll see why that happens. So, but to get there, we need to introduce few more things. So I'm going to talk very basically about the Greeks, 2 Greeks, which are very important to understand why the call is not better option in this particular case than stock. So first, let's look at delta. So the Greeks are basically ways to measure how the price of an option changes because of changing other factors. Options are affected by the time, by the volatility, by the movement of the underlying interest rate and dividends and so on, and so many different things. So delta is probably one of the most common Greeks that we see and we work with. And so I listed here 4 different ways to look at what delta is about. So the first one, which is what we're going to use mostly today, is the share equivalence, meaning that a delta is telling me how many shares do I own in equivalence as if I actually bought the stock. What do I mean by that? If I buy if I take a long call with a delta of 30, that it's the same as saying, well, I actually bought 30 shares of the stock. Now, keep in mind that while if I buy 30 shares of stock, it's always 30 shares. Those are not changing. In case of an option, the delta changes because of multiple factors. So that this is not a number that is fixed, but at any given point in time, if my delta is 40, it's like if I bought 40 shares of that particular underlying. Okay, so this is the definition we're going to probably use today for the most of it. But there are 3 more kind of variations that are really helpful as well. One is, which is very similar to the first, is the price sensitivity, which is basically telling us what happens if the underlying price increases by $1. How much will the value of my option change? Will it go up or will it go down, and by how much? So again, the delta of 30 is basically telling us that for every $1 of increase in the underlying price, my option will get a 30 cents increase in the price, which means that I'm actually going to earn $30 in this particular case. If the underlying goes down by $1, same way the value of my option is going to decrease by 30 cents. Okay. There are 2 more things to look about delta. One is the sign. If the delta is positive, it means that we are basically bullish. We want the underlying to go up because that's the direction in which our option will gain value. If the sign of the delta is negative, we want the stock to go down because that's how we're going to make money. Okay, so the sign of the delta tells us which direction we want to go. And there's a 4th interpretation of delta. It is an approximation, is not exactly, but essentially is what is the probability that my option will expire in the money. And so that will actually potentially make some money because of the option expires in the money. So it's not exactly the same because especially the longer in time you go, so the more far dated options, as well as the higher the volatility, the more the difference between the true probability and the delta diverges. But for all intents and purposes, you can take this as a very good proxy for what is the actual probability that my call or my option in general will expire in the money at the day of the expiration. Okay, so but keep in mind we're only looking at for today at the very first definition, which is what we really are looking at. One last thing to consider for today is the second Greek, which is the theta, which is essentially the time decay. What is time decay? And I use this kind of example of like a mozzarella, like food. Food goes bad, and so do options. So they have an expiration date, but the difference is that usually with food you can still eat them after a few days after the expiration. With the option, they just vanish. So the last day is the expiration day, and then they're worthless. The theta basically measures the speed at which this option will lose value over time. Okay, and so to give an example, the unit is in dollars per day. Typically, this is how all the platforms typically show you this value. So if I'm looking at a theta of negative 0.03, it basically means that for each day that goes by, this option will decrease by 3 cents. Okay. Obviously, if for example, I have a positive 0.5, it means that the option will increase by 5 there's a typo in this example, will increase by 50 cents per day. Okay. Now keep in mind that this is again an approximation because this is only valid typically for 1 day. Theta changes also with time itself and with all other things. So it's not a linear increase. It doesn't mean that I'm going to earn exactly 3 cents every single day, because it's not a straight linear increase or decrease of time decay. And I have a chart to show that how actually it decays for real. 2 more things to consider here is when I'm looking at multiple options together, I may buy some, I may sell some, I have some strategies. Typically what we look is what is the net theta? What is the net effect of some, usually short options have positive theta and long options have negative theta. So when I combine them all together, I need to look at what is my overall theta of some are positive, some are negatives, some of them are clubbed together. So if my net overall theta is negative, it basically means that there's a prevalence of long options in my strategy from a kind of a value perspective, which means that every day that goes by at that particular spot price, my options will lose in value. My entire position will lose value because the theta is negative. On the opposite side, if the theta is positive, it means that every day that goes by, my entire strategy is gaining some value. And typically what we want to have as option traders is having theta to be positive because we want the time to be on our side. We don't want to lose money as time goes by. Right? Obviously, because the time is literally money in this case, right? Every day that goes by and the theta is negative, we are losing money. So just one last slide here to show like how the time decay of an option goes. Essentially, the green line is the at the money, which basically means that the value of an option is holding as much the most if the option is at the money, and it decays slower at the beginning and then obviously accelerate at the end because eventually everything needs to go to zero. While the for out of the money or in the money options, as you can see, out of the money basically usually decay much faster at the beginning and then they slow down, and the in the money is somewhere in between. Okay. So as you can see, it's not a straight line. It's not exactly X dollars per day, but it's a good approximation to get an idea. All right, enough with the Greeks. We just got the basics. Why did we have to do all of this? Well, let's get to now comparing the stock again with the call and see how the Greeks, what the Greeks are going to tell us about this. Well, if we look at the time horizon for buying shares, my time horizon is basically unlimited, right? I can hold the shares as long as I want. So I don't have any time, and this is a good thing, right? The delta is how many is basically number of shares that I own. So it's exactly 100 shares because I bought 100 shares, right? So it's a fixed number. It doesn't change. And the third piece is that the theta is zero because, again, since there is no expiration, I can hold my shares as long as I want. Theta is not helping me, and theta is not doing me anything bad to me. It's basically, it's irrelevant. I can hold these things as much as I want. So these are the good things of owning stocks. If we look at the call, the time horizon is actually fixed because we know that we have an expiration. So we cannot hold this thing forever. We have to be right within a certain amount of time. The delta, in this particular case, I chose a call which is at the money. And this call, again, is 1 year from now, right? It's going to expire within 1 year. And the delta of this call was 60. Now, you may think, how come it's possible? Usually the at the money delta is about 50. Well, that's not quite right because this is an effect of the interest rates. The higher the interest rate, the more to the right your delta is going to move off the call because the relationship between the spot price and the future price is which basically covers the delta is due to the interest rate primarily. So that pushes your delta to the right. Yes, yes. And obviously, yeah, the farther in time you go, the more your delta moves to the right because of the interest rate. And so the delta in this case is variable, so it changes, right? Is not exactly 100 like the shares, which means that it's like we don't get as much, if the stock goes up, we don't get the same amount of revenue or profit that we would get if we actually own the stock. Because if we own 100 shares of stock and the stock goes up by $1, I'm actually getting $100 of profit, right? If I own a call and the stock goes up by $1, I only earn $60, right? So it means that it's slower in terms of the speed of which I can actually earn money, right? The other aspect to consider, and I'll get to the back in a moment, but let's just look at the other two here. The theta, which is negative, it basically means that as the time goes by, so I'll just get to the point, just looking at this particular animation here, basically the line that you see here is the at now, which is the T0 line. It shows what is the value of the option as of today. As the time goes by, eventually that line, I know it's not very visible from the slides, will eventually have to go all the way down to match the expiration line, which is the green line that we see right here. So time is against us because it's going to bring basically our profit down. As we said, every time it goes by, the option loses value, so I'm going to lose money. The gamma is positive. Gamma basically shows you the curvature of your T0 line. And because it's positive, this is actually a good thing for us, because when the stock goes down, it actually creates an edge. It makes it so such that our option, yes, loses money, but not as much as it would lose if I actually own the stock, because the stock is going to go down straight. Our option has basically a cap, right, at a certain point in time. So the fact that we have positive positive gamma is a good thing in this particular case. And finally, Vega, which I didn't talk about it today, but basically measures the change, how the volatility affects call. And I put a kind of a scale in there to indicate that it could be good, it could be bad. It depends on the case. It depends on the case and it depends on the underlying. Let me give you an example. Some people think, well, if there's a crash and the market goes down, people think, well, now it's a good time to actually buy because eventually the market is going to maybe shoot back up. Well, buying a call in such a scenario is probably actually a very bad idea, because when the market crashes, the volatility increases, which means that the price of those options will be very, very expensive. And then when eventually, if I'm right and the market goes up, I may be right directionally. I got the right direction. The problem is that usually when the market goes up, the volatility collapses, and that's going to squeeze all of the value of my options, which means that even though I was directionally correct, I end up losing money anyway. So typically on SPY, it's not a good idea to do this, but and so in this case, the Vega is actually not helping me. But if the market crashes and I have an option, the Vega will actually make the T0 line inflate, which is going to attenuate my loss. I know we didn't talk much about Vega today, but basically what I'm saying is that depending on the direction and the timing and what stock you're using, Vega can be your friend or can be your enemy, based on the cases. All right.
If you think that's right in the stock post at the bottom.
Yes, that's a good thing. Or in other cases, if you're looking at underlyings which have a positive correlation with volatility, for example, in the SPY, typically there's an inverse correlation between volatility and the stock price and the returns, right? But if you look at equities or commodities, typically they're actually they have a different thing, because the volatility increases as the stock goes up or as the underlying goes up. So in that case, it may be actually a good thing to do that, to actually buy a call in that particular case. So at this point, we can finally kind of summarize what are the pros and cons of owning stock or owning call, right? So on the positive side for the stock is that we have unlimited profits and unlimited time. So all the time in the world, well, to get it right, to be right. On the downside of owning stock is that there's a higher risk, a higher margin in terms of margin requirement, and we have no protection to the downside. If the stock drops, we're going to lose a lot of money. With the long call, we have also unlimited profit if the stock goes up. There's a lower cost. As we've seen in the example, the leverage was almost 10 to 1 in that particular example. So there's a good value for the money that I'm spending. And it's a defined, sorry, there's a typo. It's a defined risk trade, because basically there's a cap to how much money I can lose. It's already capped at the beginning, which is the value of the call. On the downside, I have to be right. I need to get the right direction, and the underlying needs to move enough to cover the cost of my call. So which means that I have to be right, and I have to be right within a certain amount of time. So I don't have all the time in the world. So I have to be time and I have to be right within a certain amount of time. These are the two things that I don't like about it. Well, that in general is not good about the call. And the other thing is that there's a slower speed at which this call is going to earn money, because the delta is less than 100, right? So it's going to, as the stock goes up, I'm going to earn money slower than I would do if I actually own the stock. And then, as I said, it's not suitable for bullish trades after market crash because of the volatility aspect that we looked at. All right. So how do we solve for this problem? That's where this zebra trade comes into place. We're trying to solve for all these negative aspects while trying to keep all of the positives that we have across all of the other ones. So here comes the zebra. So it's not actually a real animal, but it's just the acronym for zero extrinsic back ratio. So what does it mean? First, let's look at the setup. This is typically a bullish trade. You do it when you want this, you have a bullish view of the underlying. And to set this up, you basically buy 2 calls at delta 80, and then you sell 1 call, same expiration, at delta 60. So what happens with that is that if I'm buying 2 calls with delta 80, my total delta is 160, right? Then I sell 1 short call against it at delta 60. So 160 minus 60 gives us exactly 100. So we end up having 100 delta, which is the equivalent of owning 100 shares of the underlying, right? So, and the reason why it's called a back ratio is because there's a ratio between the number of calls that I buy and the number of calls that I'm selling. Why is it called zero extrinsic? Because actually, let me just go back to one slide here. If you look at this slide, the red dot shows here basically where the underlying is, and the distance on the P&L, right? This height between my value right now and the expiration value, that is the extrinsic value, because this call is at the money, so it's pure extrinsic value what I'm paying. The premium that I'm paying for that call is totally extrinsic. So I have to actually have my call to move by the same amount of money for me to actually earn anything at expiration. My break-even is basically given by the current stock price plus the amount of premium that I paid to actually purchase this call. When we look at the payoff chart of the zebra trade here, you can see that basically the expiration line is already at 0, meaning that I can start making money right away, because as soon as the stock goes up, I'm going to start making money, and my delta is, as you can see there, is 100. So dollar for dollar, every dollar that the stock goes up, I'm going to make $1 in value, as if I actually bought the stock, okay? On the left side, we still have the same type of protection like a call. It's not exactly the same. We will compare the zebra versus a call, but as you can see, there's a downside protection, but on the right side, it's basically 1-for-1 with the stock. So it completely replaces the stock. And then if you look at also the bottom, I know that you won't be able to see it there, but basically on the right here, we're looking at the Vega. And Vega is pretty much 0 all the way to the right, which means that this trade is insensitive to Vega. Well, very little sensitivity to Vega, which means that you could potentially use it in a scenario like after a market crash, because if their stock goes up, I don't have to worry about the fact that the volatility is going to go down, because my Vega for that trade is close to 0 in that range. Okay. All right. So so what are the pros and cons of using this approach? Well, the good thing is that it has unlimited profit on the upside. It has a defined risk, so my risk is limited from the beginning, right, compared to owning the stock. It has zero extrinsic value, which basically means that the theta is almost 0. So I don't lose money as the time goes by, because right away, even if the stock doesn't move, just look at this chart, right? Even if the stock doesn't move at all, I'm not losing money. If I own a call and the stock doesn't move, I'm actually losing money every day that goes by, right? Now, one thing to keep in mind is that the theta, if you actually look at I know you won't be able to see there on the chart, but the data here shows in red, which is slightly negative. And what I noticed is actually it is, depending on the interest rate and some scenarios, typically the theta starts a little bit negative, and then as the time goes by, it eventually becomes positive towards the end. But anyway, it's a value which is almost 0, which means that this is a trade that it is not really affected by the time. So you don't lose money because of time as you would if you actually bought a call. On the positive is that the delta is 100. So it's like if I have a full replica of a stock on the upside. We already talked about the Vega, that is basically 0. Now, what are the negative aspects of this zebra trade? Well, it's a slightly negative theta. As I said, there's a tiny little bit of a drag, not as much as a call, but it's still a little bit there. The time horizon, again, it's that I have to choose an expiration, right? It's not like I can hold this forever. So I need to pick up an expiration for the zebra, for like anything in options. There's a higher margin or downside risk compared to actually buying a single call, because in this case, we're actually buying two calls. The reason why we're selling one call against the two that we're buying is because the premium that we receive from selling that short call is going to pay for the extrinsic value of those two long calls that we bought. That's really the whole game in this particular case. But if you look at the payoff chart, the blue line here is the maximum risk of one single call. The green line is the payoff of the zebra. As you can see, there's a higher risk, right? So it's still better in terms of the margin requirement compared to owning stock, but it's not as good as just buying a single call. Okay. So there's one additional thing to consider which is since I have a short call in my position, there's a potential risk of assignment or dividend risk. Now, this is typically especially a longer term distance. It's a very, very unlikely, but it's there. And think of it like this for a second. If the stock goes up, my short call is in the money, is deep in the money. And if the stock is declaring that there's going to be dividend, if the value of the dividend is higher than the extrinsic value of that short call, basically my short call will be assigned, most likely, right? What happens then? Well, think of it like this. If both my calls are in the money and the stock went up, I'm already making money. My trade is already working. The annoyance is that now, instead of having a full option strategy, now I'm short 100 shares of the underlying because I had a short call, right? And so that means that my margin requirement might increase. My broker called me because I don't have enough money to maybe in my account. Whatever it is, typically what I have to do is I'm going to have to close my position. Still making money, but it's annoying, right? So it's just one risk to keep in mind, which is, dividend risk. Or if I'm getting very, very close to expiration towards the end, so that short call basically lost all of the extrinsic value. And if it's deep in the money, well, yeah, that also you have a risk of assignment. That one works, that happens with stocks. Obviously, if you do this, and one thing I didn't say, which is you can actually do this trade against SPX, an index, and then you don't have any dividend risk, you don't have any assignment risk, right? And you cannot buy SPX, but you can use the zebra trade to trade SPX like if you actually bought it. So that's an advantage of having this type of trade. All right, so what we want to do is actually figure out, can we also improve on those two red items, right? We talk about the positives. Is there a way we can try to, well, how do we choose the expiration so that we can reasonably expect some good positive returns? That's the whole point that we're trying to add to all of this. Okay, so how do we do it? I had to introduce two concepts, which are two measures of risk. So think of it like this. Whenever you own some investment, right? Typically you try to look at what is my best case scenario and what is my worst case scenario. Now, if you look at what could be the possible worst case scenario for your stock, well, is that the stock goes to zero. So I'm going to lose a lot of money. But if everyone trades based on what is the maximum risk that you possibly have, no one will be able to do this because it will require so much capital that it would make it impossible to trade. That's why typically brokers only charge you 50% margin, for example, for owning stocks, right? So that doesn't mean that the risk is not there because the stock could actually go to zero. But for example, if you're trading on an IRA account, you have to have cash secured puts if you want to sell a put, right? You have to basically have enough capital to cover for the entire possible risk. So instead of looking at what the maximum risk is, we're looking from a statistical perspective. What can we expect to be not a maximum case, but maximum within quotes? It's not really a maximum loss, but it's something which is a really, really bad case scenario, okay? That's where this concept of value at risk and expected shortfall come into place. I'll try to give you an example of these two. So Essentially, value at risk is basically saying, look, I take a certain probability at a certain confidence level. And this typically 95% or 95%. These are or 99. These are the typical two numbers, but you can choose any probability you like. And then you also choose a time horizon, let's say 1 year or 1 day or 10 days, whatever, right? And let me give you an actual example, and then we'll explain what it is. So if I say that my 10-day value at risk with 95% probability is $100,000, what does it really mean? It means that I have a 95% probability that of all possible scenarios, I may make some money, I may lose some money, but in the 95% of the cases, my loss will not exceed $100,000 within the next 10 days. That's really what we're talking about. It gives us kind of an upper bound for what our maximum loss could be within certain confidence level of probability. Now, the question is, well, what about the remaining 5%? What happens when things actually go wrong, but really, really wrong? Well, that loss, that 100K, is just the starting point. Your loss is definitely going to be higher in that 5% of worst case scenarios. And we don't know how much bad things could get. That's why there's an additional measure called expected shortfall that is basically saying, look, let's just take a look at that 5% of the worst case scenarios. What is the average of those losses that we've seen in the past, right? And that's my measure of how things can go bad, because I'm taking the average of those 5% of maximum worst case scenarios, okay? Value at risk, I'm just mentioning it because it used to be used a lot in finance. It's still used today, but there's a lot of things that could go wrong by just using a VAR. The reason why also there was a collapse in the financial system in 2008, it was also because VAR was used as one of the measures to measure risk, and it wasn't a good measure to do that, a good way to measure risk. I won't get into the details, but happy to talk about this maybe after. The other thing is expected shortfall has also a different name, which is called conditional value at risk. It's two different names, exactly the same thing, okay? All right, so why did I talk about this? Let me just give an example with expected shortfall. The same example, if I talk about a 10-day expected shortfall with 5% probability of $120,000, what does it mean? It means that within the next 10 days, in the 5% of the worst possible cases that could happen, my average loss would be $120,000. Essentially gives me like a good approximation of what can I really expect to lose in the worst of the worst cases in that 5% probability, okay? So typically expected shortfall is always more because it's a higher loss than what would be the value at risk, because it just focuses on the tail. So what you're seeing here, we're just focusing on the left side of the tail. And we try to find out what is the average of the area which is in shades. Okay, so can we use these measures to give us to choose an expiration? How do we get there? So I built a script. So I'm gonna share a different screen, just a moment. I can find it. So just a moment. There it is. Okay, so I'm going to share this. This is a Google Colab document. It's a Python. It's a mix of some text that explains what things are doing, what things we're doing, as well as some Python code that you can run at your own leisure. You can actually change the code and play with it if you want. I'll give you the link. You can just create a copy, save it in your personal Google Drive, and then basically you just look at these things. So what I'm going to do is basically I'm just going to click on the runtime and say run all, so that while I'm going to explain what this code is doing, we'll let it run. It can take up to 60 seconds or so, depending on how much stuff we're doing. So what are we doing here? First, we're importing some libraries. Python, like anything else, you need some libraries to do your calculations. I won't explain what the code does in details, but just to give you an idea. The most important thing that I really have to play with is these two lines here. Here's where I choose which one is the stock that I want to analyze. In this case, I chose NVIDIA. You can choose whatever sticker you like. And then I also choose another, which is SPY, typically is my benchmark, just to get an idea of how is this stock performing compared to SPY. You can choose any two stocks you like just to get an idea, okay? And then finally, I specified a start date. So how back in time you want to go to collect my historical data for my stock. And the end date is basically automatically picking up today's date. So it basically goes all the way down from 1st of January 2015 until today's date. So we're trying to get as much history as we can for this particular stock, okay? So once we do this, we run the script, or we just basically click on the cell, click on the run button, and it's going to do this on the fly. So if you change something, you just click on the play button, it's going to rerun that particular portion of the code for you. At this point, we just collected the data, and this is using Yahoo Finance to download the data that we want. Next step is this piece of code is basically generating a bunch of charts. So we're just going to take a look at these charts. So the blue line here is showing us the performance of the benchmark, and the kind of this kind of red and green is basically a bar chart of my ticker. In this case, it would be sorry, this is NVIDIA, right? If you want, you can also kind of zoom out again, and you can just click on any of these, and it's going to hide certain things from your chart. So if you just want to focus on certain things, all you have to do is just click on the legend here and hide or display the things you want to see. So nothing fancy here, just showing us what the values are. So next step is we want to compute what is the distribution of the returns. We look at the returns of our stock or NVIDIA in this case, and we want to see what is the distribution of the returns, the positive and the negatives, to just get a feel for how good things can be, how bad things can be. And well, at this point, we should ask ourselves, are we going to just look at 1 day return, or 2 days return, 10 days return, 1 year return? So you have all possible options, right? So what this software is going to do essentially is going to look at all possible, well, a lot of possible different variations, all the way in this case from 1 day, 9 day return, 17 days return, all the way up to 800 days of return. So it's like if I'm buying today and selling 800 days later. And then, or if I'm buying tomorrow and selling 800 days after tomorrow, right? So we're looking at every possible returns. Why do we do this? Because the timing obviously is important, right? If I buy today and sell tomorrow, maybe I get lucky and I get a return. But if I do it in a different day, I may actually get a loss. So we want to look at all possible types of returns. So what this software is basically doing in the end is creating this chart, where essentially, let me just let's hide a couple of things. Let's just look at SPY, for example. The bars are showing us what is the distribution of the returns. This is calculated on, you see the horizon, it shows 1 day. So we're looking at 1 day returns, the distribution of the returns, and the blue line is showing us what the normal distribution would tell us the distribution should be. So just to give us an idea that, and you can see that typically the returns are not exactly following normal distribution. Typically what happens is that the tails are, we say the SPY is a fatter tails, which basically means that the extreme events happen much more frequently than what the normal distribution would predict. Okay, so we can do this, and we can look at this for both distribution. As we can see right away that the NVIDIA is a much more volatile stock because the range of possible returns and losses is much wider, is much spread apart compared to what we see in SPY. And obviously SPY is an index of collection of stocks, so it has less volatility. Now, here we were just looking at returns over 1 day. What if I want to look at the distribution at, I don't know, 300 days? So I can just use a slider and look at what the distribution looks like. Now look at SPY, which still looks like more or less like a normal distribution, and look at NVIDIA, how wild this is. It's something which is much more skewed to the right. NVIDIA has a huge performance. It has like 300% performance all the way to the right, compared to over a 200-day period, compared to SPY, which in the best case made, I don't know, 40% up, right? So this gives you an idea of how wide things can get on the upside or on the downside. Okay, so we look at this one. Next is we want to look at how correlated is my stock with the benchmark, with the market. So this chart is basically showing you, and I gave a previous speech about what correlation is and how we use it for pair trading. But basically, this is showing us in this particular example that when SPY returns are positive, also NVIDIA returns tend to be positive, because the blue dots are more or less, I mean, they're not exactly on the line, but they're more or less on the line, which is the positive slope, which basically means that when SPY has good days, NVIDIA also tends to have good days, statistically speaking. And when SPY has bad days on the left side, so does NVIDIA. Okay, so this tells us that NVIDIA and SPY are fairly correlated. How much are they correlated? Well, in this case, it's 64%. That's what we see here on the right side. Okay, and again, we can do this across multiple time horizons. So you can play with this thing and see how it looks like across multiple time horizons. Go ahead. Yeah, you have a question?
Is it in the
Yes.
Oh, okay.
Yeah, we're just looking at the past. Yes. Okay, we're just, and obviously the underlying assumption is that the future might look like the past is not necessarily the same, but hopefully it rhymes. That's the idea. Okay, so we looked at this distribution, we looked at the correlation. Final step is how bad can things can get, right? We want to look at what are these value at risk, what is the expected shortfall, what is the maximum risk, maximum within quotes, that I can expect to see. So at the end of this chart, essentially, well, there's an explanation of what this bar is again, but essentially, if you scroll all the way down, you get this chart. So what is this chart showing us? Let me just start by hiding a couple of things first, and then we'll get to those. How much are we with time? Okay, we're almost there. Yeah. So let's look at the blue line. On the x-axis, it shows us the time horizon. So basically, am I looking at 1 day return, 100 days return, or 1,000 days return, right? And keep in mind that these are trading days. So 200 trading days basically means one actual year, calendar year, okay? Because in a year, you have about 200, 220 trading days, okay? So this is telling us that if you just look at this stock of NVIDIA, on average, obviously, depending when you enter and when you exit, but on average, if you look at holding this stock for 200 days, you have an average of 69% return on your portfolio. Across all possible days in history that we looked at, the average was a positive almost 70% return by holding the NVIDIA stock over 200 days, okay? Obviously, the more I hold the stock, if I hold it for 600 days, which is basically 3 years, I could see on average a return of 300%. Now, an average doesn't mean that is what I'm going to get. It could get better or it could get worse. So we're trying to find out how better could it get, how worse could it get. That's why we add those concepts of value at risk and expected shortfall. So in here, we're basically getting a cone of how good things can be, how bad things can be. So the green line with the dotted line, this is the value at risk on the good side, and the red one is the how kind of bad things can go in the 95% probability, because we chose a 95% probability in this case. Okay, and finally, when we look at the expected shortfall, we see
the red line is the conditional block.
yes, the red line. So the actually
The red line is the conditional.
the red line on the bottom, this one, the dotted one is the value at risk. And now I'm adding also the expected shortfall, which is the fully continuous line.
Like the expected shortfall as conditional.
Yes. Is a exactly the different name, but the same formula, same calculation. Okay. So what we're looking at here, and I'm going to try to zoom a little bit. Okay. We're basically saying, just to give you an example, let's just zoom on this part. So what this is showing us is that if I buy and hold the stock for 348 days, my average return would be 133%. On the good side, I mean, if things really went well, in the 5% top best cases, I could get up to 411%. If things get really bad, my worst 5% had an average of 32% loss, okay, over that duration. Now, what we want to do is, if you look at this chart, and I zoom out again, what is it? At some point in this particular case, even the worst case turns positive. That's what this point is showing us. It's telling us that if I hold the stock for 533 days, even in the 5% worst cases, I'm still going to get a positive return on average of 1%. So this is basically telling us what is our expiration date that we should choose, so that statistically speaking, we have a very high likelihood of not losing money. We may not make money, but we have a very good chance of not losing money. That's the whole point of this analysis. So this automatically calculates what the crossover point is. What should be my DTE of choice to try to reduce my risk. Obviously, I'm done. So the obviously 533 days, it's a long time to wait, and also it means that my zebra is going to be quite expensive. So you cannot always get there. Plus, some stocks don't exhibit this type of behavior. Some stocks always have a negative side, and there's nothing you can do about it. They're just too volatile. So long story short is, you're gonna get this link. You can play at your own pace. I don't have time right now to show you what additional things you can do to even improve your chances, which was basically adding different type of color strategies on top of the stock. We don't have time for today. Maybe we can do it another time. But
absolutely.
But just to give you an idea of what we can do with this trade on a longer term horizon.
So you'll send some of that stuff
Yes,
to me.
link, and you can put it on the link. It's an Italian website because we do research in Italy for the Italian market. But anyway, you can send me an email there, and I'll reply to you guys. Rahim was asking, once you set up Zebra based on DTs from the coding script, do you have any strategies to help lower the potential loss on Zebra trade? Yes, what I do basically, and this is true for any long-term trade or actually any trade which is that has directional exposure. So keep in mind that I would say 95% of my trades are delta neutral, so I don't trade directional, probably because I'm very bad at picking a direction. So that's why I tend to stick with positive theta, delta neutral. But if you do directional trade, I want to protect myself, right? And I had prepared an example for today, but that's going to take more than 5 minutes to show you. But the idea is, whether you own stock and you want to protect your stock, the simplest thing you can do if you just own a stock is to sell a call at about 16 delta, more or less. So basically you go one standard deviation away on the right side, and you sell one call. So now you're turning your stock into a covered call essentially, okay? And now you can use that premium that you collected from the call to actually buy a protection. So you can buy a put on the left side of the stock for about the same amount of money, sometimes a little bit more, sometimes less, it depends. So now instead of having a payoff that looks like a straight line, it looks like a Z, or actually an inverted Z or something. So it means that you have capped your maximum profit, but you also capped your maximum loss, right? Now, this is the simplest way you can protect your trade. But the point of this is, if you put yourself at least one standard deviation away, you have about 68% probability that within that expiration because the color typically is done on a shorter term expiration than what your zebra is. So your zebra is your replacement for the long-term stock. And now you're going to protect the zebra with a color at a shorter dated stock. Now there's advanced techniques, because selling a call and buying a put, usually selling a call is not enough to actually buy a put. So you can get fancier and do something else. And I'll show you maybe another time, but yes, there are ways you can protect yourself for those things. Question from Romy: with a margin account, buying 100 shares of Tesla is less buying power than a 365 DTs. Zebra, since options are not marginal categories, yes. Is the Zebra trade really margin efficient in that case? How should I think about it? No, you're right. So if you have a margin account, typically margin account are looking at what could happen if the underlying goes down by about 12%, if I remember correctly. And they look at what would be your T0, your loss on the T0 line, and that's how much money they will margin to you. And that might be lower than what the cost of the zebra is. So in that case, this is not an efficient. If you're just looking at efficiency from a margin perspective, it might not be an efficient trade, but you still get the benefit compared to a call of 100 delta. I mean, you get all the other benefits. You just don't get the benefit of the efficiency if you already have a portfolio margin or like a span margin, for example, right? Which kind of operates in the same way. No, I'm not, John. I'm not sharing the screen. I was just talking. But because they're gonna kick us out of the library probably like in 2 minutes. So well.
So thank you very much, guys. And we really have to shut down much more promptly than we normally do, because the library has a rigid schedule here, which we have not had in the past. But I think it was a great start all the same for a hybrid Zoom in-person meeting. We actually had an excellent turnout, 45, and altogether signed on, plus another number here. So actually it was overall an excellent turnout. The video should be fine. I'd like to thank everybody for coming. And I'm afraid we better call it a day.
Thanks, everyone.
Thank you so much. Could you stop the recording?
Yeah. Well, it should be the same as. 1 second.
So thank